What's up, everyone? We are going to do an advanced LBO stream, and this one, I'm pretty excited to go through this LBO with all of you because I spent a lot of the past few days kind of remembering how to do a bunch of the stuff we're going to go through today. And I wanted to start off by showing you exactly what you are going to end up building. You're going to be able to download this Excel for free later on, but I wanted to show you just like an overview of what we're going to be building, so you kind of know what's in store, I guess. So starting off from the top, we're going to be actually finding all of these assumptions ourselves. So whereas in previous, I guess the one LBO stream I did and my DCF videos where I have a lot of the information downloaded, for this stream, we're going to be finding every single piece of information here from filings and And so it's going to entail a lot more work just gathering all the figures. And that's going to be a little bit new. We're going to go into filings that normally a lot of people don't know about, which basically is like the proxy to find a lot of the key specific information for the actual transaction. And I forgot to mention, so we're going to be going over a real LBO that happened back in 2010 when a private equity firm named 3G acquired Burger King. And I wanted to choose Burger King because everyone knows that company. And so I thought it'd just be a little bit more interesting. And because it was a real deal, we can actually go back and find a lot of the figures that we need. And then we're going to build sources and uses, very standard for an LBO. Then we're going to build out these assumptions here. I'm going to actually track down all the historical financials. And then build out some cash flow items, then levered free cash flow, debt schedule, and then interest rates, and then our IRR. So I kind of showed you guys, I kind of gave away, I guess, what we're doing before we actually kind of do it. But I thought it would be a good way for you to kind of see what exactly we're going to be doing. So to give you an intro to everything here, previously I did an LBO, a simple LBO model stream, where I gave you the assumptions. We built out sources and uses, worked on a basic operating model, basic debt schedule, IRR calculations. In this video, we're going to, as I said, find all the assumptions based on real transaction figures. We're going to build out sources and uses table, operating model with 2 scenarios, and then a debt schedule was a circuit breaker and IRR calculations. So this is part 1 because I don't even know how long this video is going to take. It could take 2 to 3 hours. And I'm not trying to sit in front of the screen for like 5 hours, because in the next 2 LBO modeling videos that I stream, they're going to be continuations of what we build on today. So in parts 2 and 3, there's going to be a lot more that we build out. So including revenue cases, separate historicals tab, forecasting cash flow statement, and balance sheet, so a full 3-statement model. Additional debt tranches, such as adding a revolver, mandatory debt repayments, paid-in-kind interest, cash sweep, LIBOR, amortization of financing fees, sensitivity tables, adding a DCF. So there's a lot more that we're going to be adding on and building off of what we do today. So there's going to be a lot of, actually just a few new Excel modeling type of shortcuts formulas that we're going to use. Actually, basically one called a sticky if statement, which is not like super hard, but you're not really going to find it in many. Or what I mean is that it's kind of hard for anyone for you to really know what that is and to be taught it anywhere else besides actually if you're in banking or watching the stream, I guess. No one else really uses it. Notes. So this model will be available for free to download after the stream ends. You can check out the description for that. New Discord channel. I've been super slow about creating this, but it will be available soon. So it'll be in my description at some point, hopefully in the next few days. I also am building out a how to get into investment banking course, which you can sign up for early if you'd like. And then there's a bunch of videos that I've listed in the description, which you can check out if you'd like. Also, I guess, the guy who created this model. So I have a bunch of links in this model later if you want to check out, or in the description. I actually, before I actually stream, I'm going to try to mention on my Instagram stories when I'm going to be streaming. I have uploaded that right now. So feel free to check that out if you like. And with that said, I'm going to add a tab, move this over to the end, and then this is going to be our LBO. Now, before I go into this, though, wanted to let you guys know about today's sponsor for the video, Wall Street Prep, who has created a private equity certificate program with Wharton, which is where I got my MBA. And if you're interested in breaking into private equity, this is certainly a program you can consider. It's an online course. It's not cheap, $4,800 for the entire course, but you really get a lot out of it. And you can use my code RareLiquid to get $300 off. Apply early by this deadline to get $200 off. And this program runs 3 times a year. So depending on when you watch this video, this date might be a little different. But you can see here that a lot of prominent private equity firms work with Wall Street Prep and Wharton, like KKR, and then there's like Blackstone here. Carlyle, I know, is part of it as well. And then a lot of people who attend this program are people who are actually kind of already working in the finance industry. So a lot of time there's bankers or investment professionals and just want to like sharpen their skills, meet people, etc. You can see where all of these the applicants and people come from. And then if you go down, you can kind of see it's an 8-week program, 8 to 10 hours weekly time commitment, but you kind of learn at your own pace, which can be a plus if you are busy and don't want to necessarily kind of go to school to learn this stuff. And you'll learn things about an intro to the private equity class, the PE investment framework, private equity deal process, deal structure, modeling, and how to think like a private equity professional. The faculty and speakers include Wharton professors, keynote speakers, David Rubenstein, legend, who co-founded Carlyle. And then there's Martin Brand, the head of North America for private equity Blackstone. A lot of like cool speakers. There's actually a ton of them. And then another cool thing is that Wall Street Prep and Wharton actually kind of create this. If you go join this program, then you're able to meet a lot of the peers. I know they're having in-person events. They actually invited me to one, but I wasn't able to make it in New York, Los Angeles, a bunch of other places. And then the other thing is like there's exclusive recruiting events with the top private equity headhunters. So feel free to check this out. I'll leave a link to all of this in the description if you're interested. And with that said, let's go into Burger King. So I'm going to also be answering questions in the chat if you ever have them. So feel free to ask away as I kind of build all of this out. And as I kind of mentioned, this is probably going to take a while. So let's start off with the basics. So Burger King acquired by 3G Capital, $24 per share, transaction valued at $4 billion. So this is when the transaction was announced. You can see here September 2nd, 2010. And what ends up happening, though, after an announcement, and this is true with almost, actually, I'll just say it's very true a lot for private equity transactions, where the transaction value that's listed and a lot of the information and like the amount of debt taken on and all of that, it kind of changes once the transaction actually needs to close and then details are kind of ironed out. So the numbers we're going to see are going to be a little bit different than some of these, except like this $24 per share. But this is really like when you are starting off with any transaction, you always want to start off with the press release because there will always be a press release. So I'm going to I have a screen up here, so I'm going to be looking up here quite a bit. So yeah, I built everything from scratch, but then I want to make basically the model that we built pretty much the exact same thing as I showed you at the beginning of this video. And so to do that, I'm going to be kind of looking up at the model that I built here and there a little bit. So starting off, we're going to build our different sections. So we're going to have assumptions here. Oh no, this is going to be for switches. Although I don't know if I would start with switches when I am building out a model. 3 or 5. Let's do 5. Okay, so the two switches that we're going to need are a circuit breaker and then a case. And I'll explain what those mean later. I'm also going to make these columns bigger, size them 15. And then assumptions here. Oh, this also might be too small. Let me zoom in a little bit. Okay, so let's think about the assumptions that we need. Let's see, we'll call this transaction background. And then over here, we're going to call this evaluation at entry. And so for transaction background, let's get our company name, ticker, latest closing share price, latest closing share price date. And then I'm going to add some borders here. All right, company name, Burger King. The ticker before it was acquired, BKC. So, I forgot. Actually, it should be obvious based on the fact that there's like $1 per share, but the Burger King was a public company, and then it got taken private through this transaction. So ticker BKC. I'm going to make these blue. There's a certain blue that I want, though. It might be this one. Yeah. Okay, latest closing share price. So the transaction was announced on September 2nd, so that means that the latest closing share price, the last price when it was public, was the day before. Oh, share price. Oops. So that's the date. And then to find the latest closing share price, we could let's go to Burger BKC, share price history. Might be a little bit hard to find. All right, historical. So this makes sense because the transaction closed at $24. Okay, so we're going to have to go way back. Go back to 2010. And let's go to September. And transaction closed on the 1st. So this should work. Okay, closing price, September 1st, 2010 was $18.86. And sometimes this isn't, you'll see why we need this later, but sometimes this number is not even what you actually want, because sometimes the deals get leaked, and so before the announcement, the stock price will already have run up. A lot of times when that happens. Sometimes actually people even say that like the really like old school bankers, even though everything should be super, super confidential, they actually leak the information somehow through their ways to news outlets, and then they add pressure to the deal. I've heard about that before, but we're not sure if that's actually true or not. So let me answer some questions. So is this Burger King India or restaurant brands? This is Burger King, like the entire company. I'm not sure what Burger King India is. Good website for free street estimates. Honestly, I don't. I think I would. Yeah, I would just Google it around, but I don't really know. Would you be able to show your assignment at Wharton? Not in. Actually, I don't. So I can't share that because there's just too much information in there. So no, I can't. Sorry, because that was for like a real transaction. Okay, so what we want to do here is kind of figure out our valuation at entry, and so we're gonna need to get the offer value per share. We're gonna see what the premium or discount is. Then we can get the offer value, which is basically your equity value. And then diluted shares outstanding. So that's another thing that we have not done before, or I haven't done on my streams, of how to actually calculate your diluted shares. So that's something we're going to do. Then we're going to need our debt and cash figures. I'm going to indent this a little bit. And then that gets us to our enterprise value. I'm going to just, yeah, okay. Capitalize this. And then LTM EBITDA, which we're going to calculate way later. And then that we're going to back into our entry multiple. So we're not going to be able to calculate everything right now, but there are certain things we can. So this offer value per share, as we have this seen here, is $24 per share. And sometimes even after an announcement, there can be another buyer that swoops in or something, and there could be additional things that happen that cause this to increase. But in our case, that's not going to happen. So it's just 24. And then the premium is our offer value divided by our previous price. And that gets us to 27%. So basically, when Burger King was bought, the investors received a 27% premium, which is not bad. Okay, and then diluted shares outstanding. This is something that we are going to calculate later. Debt cash we also need later. So everything else here we're going to actually calculate in a little bit. I want to work on another section first. So transaction, financials, and assumptions. So things that we're going to need are our LTM EBITDA, debt, cash, minimum cash. This is also something new. And then exit multiple. I see a question, is this going to be available? Yes, these streams are always going to be available. Okay, so LTM EBITDA. So these are all going to be numbers here that we are going to need. Let me change the formatting a little bit. Okay, this is very OCD of me, but I just want there to be like an extra space a little bit here, because all the numbers, when I'm formatting, I usually do it that way. So I'm actually going to steal from one of my other models. Okay, let's use this formatting. All right, let's check this too. Should be fine. Okay. Also, another thing that I'm going to do throughout as I build this model is add comments, which I normally don't do. But what's really good practice when you're building out models, when you're in banking in particular, or in actually any model that you built in any finance industry, is adding comments so that people know where you found your information. So if you press Shift F2, you can add a comment. And then I'm going to add here that, you can find it at this link. That way, someone ever has this model, they can see where you got your information. So LTM EBITDA, we're going to get later. Debt and cash, these are figures that we need to pull up. And I'm going to grab this. You can get this information from a variety of different sources. But so all these links that I have up here and we're going to go through today, at least these 6 are going to be are already in the video description. So when you're thinking about, okay, so this company was acquired in 2010, September 1st, and for whatever reason, Burger King kept reporting more filings even after acquisition. That's very odd. Usually the company stops. There is a good reason as to why this company in particular did, but I didn't really look into it too much. But basically, if I were trying to figure out, okay, what are the latest debt and cash figures at the time of acquisition, you have to think like, okay, it's September. You have to go back and think to yourself, okay, it's September 1st, 2010 right now. And I am traveling back in time. The information that would be available to me is only starting September 1st, 2010 and before that, right? All the numbers here, or all the filings here. After that, the figures are not available. So if we didn't have all this information, then we would use the 10K debt filing or 10K filing here to grab our financial figures. And so this is the 10K. If you go to financial statements and go down, you can see that there is this balance sheet here, right? What I'm going to do, though, is later on use some of the filings that came afterwards, and you'll see why. But let's start here. So, okay, we need to get our cash and debt figures. So let me go here. So debt, starting off with debt, current portion of long-term debt and capital leases. So capital leases are always a point of contention in terms of whether or not you should add it to your debt. And the way I was taught it at JP Morgan was pretty much never add capital leases to your debt, although it can be argued that you should, and also could depend on the industry. I was in healthcare, and so maybe that was one reason. But capital leases are basically assets that you need to pay like a monthly, or maybe, usually monthly kind of payment for. So it kind of is like that, where you have like an interest rate where you're constantly needing to pay, but you end up eventually probably like owning the asset. It really depends on the contract. But because it's kind of like you eventually own it as an asset, it's treated a little bit differently just than versus debt, where like for debt, if you pay it off, it's just gone, right? Versus a capital lease, you might end up owning it or something like that. So basically all that's to say that I'm going to not include capital leases, and I'm going to show you also why I think that makes sense for this model a little bit later on, like my justification. So 93.3, you can see this includes capital leases, right? So I'm going to have to take out the current portion of capital lease here later on. So debt equals 93.3 plus our total, our term debt net of current portion, 6667.7. So there's that. I'm going to also add a note here, 10K, page 72 for now. And then our cash is a lot easier. It's just cash and cash equivalents. Sometimes there's like other stuff, but in our case here, it's pretty simple. And then I'm going to copy this comment. Oops. So copy and comment, Alt ES C, enter, if you have a PC. Okay, so let's find the current portion of capital leases that we need to take out. So to do that, maybe I'll look up 93.3. Nope, capital lease. We're looking for the current portion of capital leases. Okay. So the remaining balance, blah, 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 which 5.6 and 4.8 are classified as current portion of long-term debt and capital leases as of June 30th, 2010, etc. So this 5.6 is what's included in the current portion of long-term debt and capital leases. So that's what we want to subtract. Okay, so we're going to take this out and then add another note. So 10K for this for the debt, and then 10K page 101. This is for current portion of capital leases. And you can make this a little bigger. I'm gonna add the I always just add the link, because basically what, as an analyst, if you add this, the associate is always going to check over your work, right? And so as they're checking this over, if they're like, oh, okay, I see it's like in the 10K, whatever, it's just an extra step for them to have to like find everything. So if you add the link, they can just copy paste it, right? So I'll just add that here too. But after a while, if you're like always referencing it, you don't probably need to do it for every single one. Okay, so let me go a little bit into why I think, again, like capital leases, taking it out also makes sense. So we're going to go into this proxy statement. This is called the prem. Actually, I don't really know how they call it, but usually it's like, I think def M 14A. This is preliminary 14A. The way you find this also, like normally if you have BAM SEC, then you can see what all of this says, but I didn't want to pay for it. So, and you can still access everything. You just don't see what the titles are. But you can guess where they are, right? So the proxies here, whenever a transaction occurs, whether it's an LBO or just a strategic acquisition, there's always going to be proxies that are available. And honestly, I don't know what all of these are, but the one you're looking for is one that has an M in it for like merger. And usually there's one that's not a preliminary one. There's like, I think def M14A, but for whatever reason, I couldn't find it. So this one is like good enough. We'll use this. And when we go here, if we go into, I'm going to have to find what we're looking for, but the merger. Okay, so if you go to the merger, there's a lot of good information. You can like go to town on this stuff with like all the background and whatever you want. A lot of really interesting background for every single transaction that happens. And all of it needs to be public because of the SEC. So you can see here when the proposal was made. So it was made like April 6th, and then all this stuff happened. Thing I'm looking for. Oh, actually, this is not what I'm looking for. I'm looking for, was it merger consideration? Financing. It's either one of those two. Yeah, I think it's financing. All right, so yeah, this is what I'm looking for. You can see here so this kind of alludes a little bit to sources and uses, but you see here, we anticipate the total funds needed to complete the merger, including the funds needed to pay our shareholders, which will be about $3.3 billion. So this is where they're paying the equity holders $24 per share. And then repay indebtedness of the company, approximately $729 million, right? So if we were to include the capital leases, I think we get further away from that $729 million. And so that's why, like, I think there's like a good, for the private equity investors, like I imagine they just kept the capital leases, maybe like refinanced them later, or who knows what happened. But I think it makes sense to get closer to this figure. And then you can also see here, funded through combination of 1.5 billion in equity financing, 1.9 in, these are all the debt tranches. And so we're going to kind of reference this information later, but use information from elsewhere. Okay, so some other key pieces of information that we do need to get, though, is what is the minimum cash balance required? So I'm going to basically try to figure out all this information in the filings. And let's go through that. So this 10K is from 2011. So if you remember earlier, I mentioned, okay, normally you want to only look at the filings, or you'll only have the filings from when the transaction was announced, and then the company, once it's private, are not going to be publishing 10Ks, 10Qs. But Burger King did for whatever reason. So what's really helpful in our case is that we can go to the 10K a year later, and they're going to list out all of the important information we need for what actually happened for the transaction. So let me figure out what page that was on. The thing we need is on. Okay, page 87. So I guess how you would find this otherwise is minimum cash, cash reserve. 3G. That's too many. Okay. I'll know when I get to the page. So I guess I should also explain what I'm looking for. So I guess first, if you go into the, this is like the notes to the consolidated financial statements, you can see here that on September 2nd, 2010, the company entered into a merger with 3G, which is a private equity firm. And so if you go down, this has a lot of information of what we need. So as you can see here, required total cash of 4.3 billion. And as I talked about, this is different from the 4 billion here, right? So as I mentioned earlier, like what you see here, it just can be a little bit different. And we want to get closer to the actual figures of what really happened in order to get to the most accurate IRR that we eventually can, right? So that's why, since we have this information, we're going to use this. Other times, if companies aren't like filing these 10Ks or whatever after they're taken private, then there will be a lot of news articles and sources where you can find this kind of information. So the thing that I'm looking for here is this 69.4 million of cash on hand. So there's this concept that you should know of minimum cash. And it basically, whenever a transaction happens, you're going to need some amount of cash in the bank to run the business, right? Just because you're acquiring the company doesn't mean you start off with a zero cash balance. And so there is like this minimum cash number that we're going to need. We're going to back into it a little bit later, but this is something that we're going to be needing a little bit later. And then, or actually we could do it right now. So minimum cash, 69.4 million. Basically, it's your cash minus this minimum. Or let's see. Oh, 69.5 million, sorry. 69.4 million cash on hand. That's what they used. So the minimum cash balance is that they're going to need is the amount of balance on the balance sheet minus the cash that they actually used. Sorry, that was confusing. So let me start from the beginning so you understand. So this here talks about how the entire transaction was financed. So 4.3 billion was financed with 1.56 in equity, 1.5 in debt, another 250 million euros, and 800 million in senior notes, and 69.4 million cash on hand. So 69.4 million of the cash on the balance sheet was used to finance the transaction, meaning that the minimum cash that the company needs is 118.2. So that's what we're going to have. And this will make a little bit more sense as we build out our sources and uses table too. Exit multiple, we're going to need to get a little bit later. So let's now start building out our capital structure. And I know a lot of this is taking a long time to get through, and that's just the nature of this. Okay, so I'm going to move this down by 1. Oops, what's happening? Okay. All right. So as you can see, we're kind of building things out in piecemeal. Like not everything can be just done section by section cleanly. So let me just also add a note here. This is 2011 10K page 87. And then Control L, you can get the link. It's a Chrome shortcut, not an Excel one. Okay, so capital structure. Let's look at what we have here, which is the financing, right? So a lot of this information is a little bit different than what you get in the, I actually don't think it's even listed here, in the in the proxy, right? In the proxy, it says here, we're going to finance the transaction with roughly 1.5 billion in equity, 1.9 in senior credit facility, blah, blah, blah. But in the 2011 10K, you can see that it was 4.3 billion, 1.5, 1, 250. So they added like a euro tranche, 800 in senior notes. So we're going to use the numbers that the private equity firm actually dealt with. So to build this out, we're going to need to write down what these are. So secured term loan, there's a USD tranche, and then the secured term loan, the euro tranche, and then there's senior notes. Right, that's what they have here. And then 1.56 billion equity, we need that later. This number we're going to try to back into basically. 1.51 billion. So let's have amount, and then we're going to need, times EBITDA, the interest rate, fees, the actual dollar value, and then the term, like how many years, and then amortization. So we're not going to actually use this information in this video for how to amortize fees and stuff like that, but we are going to a little bit later. So let's start off with the amount. So the first tranche was 1.51 billion. And we want to make this blue. So I'm going to copy this formatting. And then I want to add a note of where I got this, right? So 2011 10K, page 87. And I'm not going to add the link because at this point I've added it multiple times. 250 million tranche, but this is in euros, so I want to get this somewhere else. This discussed in note 11, and then $800 million in senior notes. So let's go to note 11, which is going to be way down here. Okay, so what I'm looking for here is the euro was 250 million euros, but I want the US dollar figure since we're doing everything in USD, and that'll be just more accurate. So this is 334.2. And then we can add this new note here, Shift F2, 2011 10K, page 105. And I'm going to actually make that same comment. So Control Copy, Alt ESC, because we can get that information here as well. And then 800 million in senior notes. EBITDA figure, we can, I guess, build this out for now. The number is going to be, it's going to have an error for a while. Oops, I need to anchor this. Yeah, I don't love seeing that as I build out a model, but oh well. Okay, so, and then you can see the interest rates here as well, right? 6.82%, 7.11, 10.19. And let's get, okay, 6.8%, make this blue. Blue color coding means it's a hard code, by the way. 6.82%, 7.11. 10.11, and then 10.19%. You can see the maturity dates. Well, actually, fees. Let's see, fees. This is something that I'm going to need to back into as well. So let's do that after I add one thing, which is the term. So, okay, so term, this transaction happened in 2010. So you can kind of just like think about this and think, oh, okay, so maturity is 2016, so it's like 6 years, 8 years. So 6, or the other ones? 6, 6, and 8. I'm going to format this so that it says years. Also make this blue. Okay. So fees, all of this, we're gonna, should we do it now? Actually, yeah, we need to do it now. So in this filing, if we go back to where we were looking at the actual transaction information, whenever a transaction happens, there's a ton of fees. Well, actually, it seems like a lot, but I guess it's just like a small percentage of what actually happens. But fees and expenses related to the transaction total 91.2 million, including 43.2 of investment banking and legal fees, which we will add later. Compensation related fees of 34.5 million. And then commitment fees of 13.5 million associated with the bridge loan, which are blah, blah, blah. Debt issuance cost capitalization total to 69.2 million. So essentially, the fees for the debt issuance need to be 69.2 million. And for me, what I like, you're not actually given the real percentage. It may be possible to find somewhere, but I think it's kind of hard to find that information. So I played around with these figures. So this is kind of something where it's not going to be something super quick for people to, for you to figure out in like a real, if you're building this like without me doing this already. But if you're just joining, basically I built out this model in advance of the stream. And so I already know a lot of this information. And basically what we're doing here is just, I figure, okay, well, say the fee for the first tranche is 2.7%, the next one's 2.5%, next one's 2.5%. And then if we sum this up, this gets us to 69.12. So pretty close to the 69.2 that we need. Maybe I make this like 2.7, 2.71, 2.51, 2.51. Okay, so we're at 69.2. So now we have our fees, and then amortization of fees. This is not something we're going to build into our model, but we are in the next part 2 and 3 of this LBO that we're going to be building out more and more over time. But essentially, you're going to need to model this in at some point later on. And so these fees are something that you can kind of amortize. And so basically what this means is you divide it by the actual fee, and then you can kind of like take it out of, I think I have to double check this, but I believe that you can, I forget actually if it comes out of the income statement, but I'll know this by the next video basically. Don't worry about it, but I wanted to build it out so we have it ready for the next video. And then we're gonna have the total here. So the total equals the sum of this, and then that we need later, but we do want. Okay, I'll fix that formatting when I need it. Amortization. Okay. Make this gray. All right. So we have a lot of good information here now. I think what I want to do next is build out a lot of like what's up here. And to do that, we're going to need to build out our diluted share count. So something again that we haven't done before. We're going to call this shares. And I'm actually going to take from the model that I built instead of recreating all this and just also kind of explain what everything is. And then technically you can, since you'll have this model, you can build everything out on your own as well, if you'd like. Okay, so, and the reason I also didn't want to build all of this out too much is because even when I was at JP Morgan, all of the, like I never calculated this from scratch. We always had something like this to calculate our fully diluted shares. So let's start off with the offer price, which we have over here. I'll explain what all of this means step by step as we go through it. I'm going to make this green. And green means that it comes from a different sheet. Basic shares outstanding. So no, we can't get it here. Let me think about where I got this last time. Okay. Okay, page 88. All right. So you could go to the 10K cover, which is actually what I initially did, but I decided after digging around more that I wanted to use a different number. So the number of shares as of August 19th was 135,882,000. But if you look here, so in the notes here in the 2011 10K, there's a section that talks about how much cash was paid to equity holders, and then for everything they purchased, and then this represents cash paid, $24 per share for 136 million outstanding shares. So there are some more shares issued. I thought this was just a more up-to-date real figure. So that's what I want to use. So 136.5 million. And then I'll add a note. This is from the 2011 10K, page 88. I'll explain what all these mean later and all of this stuff. But when I was at JPM, we also had this kind of like table. And in our case here, let's look up options. There's always like an options table or options information in the stock-based compensation note that gives you information about how many options they have and everything. So as of October 18th, 2010, 7.41. Yeah, okay. So this is as of October 18th, 2010, which is, again, like a little bit post the transaction, but I think this is best number to use, versus this one, which is as of June 30th. Okay, so 7.4212 million exercise price. This is $17.43. And normally, a lot of 10Ks will break this down into a lot of different tranches and have a different exercise price for each, because this is a weighted figure. But for whatever reason, Burger King doesn't. And so I'm not going to be able to show you how to like just enter in all of this information, but maybe in the next, like, I plan to maybe like build out this LBO for Burger King and then another LBO real transaction in the future. And so maybe like I'll show you this sometime in the future. But all of this is kind of basically working towards figuring out which shares are in the money. So what that means is if the share price, offer price is above the exercise price, then it's in the money, because the exercise price is the price at which the owner of the option, if it's vested, can pay to purchase a share. So if it's $17.43 to purchase a share, anyone in their right mind would exercise that option, because you can buy it for $17.43 and sell it for 24.3, right? You can make this profit, $6.57. So this basically just, you can think about it as, okay, if that's true, then we can assume that the dilutive share count, it's not going to increase exactly by 7.42, but that's kind of roughly like the thinking here. But you need to use the treasury stock method to actually figure out how many shares would actually be issued. So this, to go through like what all these numbers mean. So in the money exercisable options, so that's like 7.42. And then total proceeds are the exercise price times the number of shares. So that's some product of D21, like this column, like it's just multiplying each of these, but all of these are zero. So basically it's just multiplying 17.43 times 7.42. Total shares repurchased are total proceeds divided by our offer price. And so the net dilutive options are actually this 7.4 minus 5.4. These are the actual options that are newly issued. And then diluted share from other securities. So there are not only stock options, there are also things called like restricted stock units, performance stock units, I think. Sorry, let me move my chair. But these are shares where the exercise price is actually zero. These are like more special, I guess, and given to, I don't actually know, like executives and stuff. But these are basically, hey, if you fulfill your contract or whatever, you can actually earn shares and not have to pay this kind of exercise price or anything. So there's 1.7 million for that. And then the, so this, let's add a note here that we got it from page 99. Or this one is page 100. So 2011 10K, page 100. And this is, we got from 2011 10K, page 99. All right. So let's link to, so we're going to do something a little bit different. I'm going to show you why, but diluted shares outstanding. Let's link to this. Make this green. And then for now, we can calculate our offer value or equity value or whatever times our fully diluted share count. Right, but the reason that I'm going to do something, so normally what you should do here is add, wait, let's see. Okay, normally what you should do here is get your basic shares outstanding plus dilutive shares, net dilutive options plus your dilutive impact of shares from other securities. So that means it's 140.3. So this adds your shares outstanding plus your stock options plus the RSUs and all that stuff, gets us to 140.3. And that gets us to 3.368 billion. But the reason that I didn't want to do that, let's see where, I'm gonna have to remember where, let me, here. So I go to page 87, I think. All right. So you can see here, the number that I really want to get to is this figure here, because again, this is the actual amount that 3G ended up paying for these shares, right? 3277.3, in total 3325.4. So they talk here when they actually made the transaction, they settled 48.1 million. So instead of, for whatever reason, instead of paying for these stock options and this these like RSUs or PSUs or whatever, they paid like a different amount instead, which if we look here is like the 48.1 million, right? So let's see what I did. Yeah, okay. So 48.1 million, in order to get the number of shares that they actually paid for the stock. Okay, so 48.1 divided by our offer price. Basically, this basically what I'm doing here, you pretty much would never do anywhere, but I'm just doing this to back into a number, So this is in the 2011 10K, 2011 10K, page 88. This gets us to 138.6 shares, and this gets us to an equity value of 3325, which is exactly what we want here, right? So that's why I am doing it this way, to get to the exact figures that the company actually paid, in order for us to just get to the most exact, exact IRR as possible. Okay, so we have this debt. We can go here. Cash, we can go here, and then make these purple. And then we can back into our, or get to our enterprise value, which is our offer value plus debt minus cash, 3893. And then LTM EBITDA we'll get a little bit later. So we'll enter this a little bit later. Exit multiple, we're gonna make, well, I'm gonna do it later. Okay. So let me think about what we need to do next here. But I also want to, let's see, capital structure. Add a row here. Okay, so we did a bunch. Let me see if there's any, there are questions here in the chat, because I know I've been just ignoring it for a while. But in a comparative company analysis, do you use industry average multiples or regression-based multiples? I haven't used regression-based multiples before. Maybe some people use it, but I've never. Would you be able to make up the case for us on your online course similar to your assignment? For my banking course, I don't think you need to build out something like the banking course I'm building is going to be aimed to help you know exactly what you need to know for banking recruiting, not necessarily like building out intense financial models. Maybe like I could build like a modeling one later down the line. Could you explain the rationale behind minimum cash? I'm going to do that a little bit more in a bit. When you say you're making it from scratch, what software? From scratch just means that we started from an empty Excel spreadsheet. Okay, so let's see. Capital structure. Next thing we need are sources and uses. Actually, I'm going to make this. So this is going to be our source. Oops, actually. Sources and uses. We're going to make our sources table here and then our uses. All right, so sources and uses, if you're unfamiliar with, sources is basically the new capital that you're going to be using to make to fund a transaction, whereas uses are everything you're going to be using that money for, essentially. So when you are thinking about, okay, I'm going to fund this transaction, what a private equity firm does is they use a lot of debt to fund the transaction. That's like the whole thing behind what they do. And so these 3 tranches that we built out, secured term loan for USD, for their Euro one, and then senior notes. And then we also can see from, oh man, where was it? I think, oh, here, okay. The acquisition of approximately 4.3 billion. We're financed with 1.56 billion in equity, so that's what we want to make sure that we have for for the equity figure that the sponsor pays. And then these debt tranches and 69.4 million of cash on hand, right? So they funded it with the 3 things that we added here, plus cash on hand. And then sponsor equity. Right, so those are the sources that the company has said they used. So we can write total here. We can have the amount. We're going to need, let's just copy this actually. And then percent capital. This should look familiar if you watched my previous LBO videos. Uses. So we can just link to what we have here, which is the amount. We'll make this purple. Cash on hand. So they talk about here 69.54 million cash on hand, right? So that's simply the amount of cash the company has on the balance sheet minus their minimum cash balance. So again, kind of explaining what all of this means. When a company is acquired, it still needs cash to run the business, right? Burger King, once it is acquired, doesn't mean that the company can just have $0 in its bank account. It's going to need like working capital basically in order to keep funding the transaction. Keep the business going. And so the company has $88 million in cash on the balance sheet, but 69.4 million of that was used to fund the transaction. So they just took it from the bank accounts essentially and then funded part of the transaction with it. So that's the 69.4 million. And this minimum cash balance is implied that if you take away the 69.4 million that was used, this is the amount of cash Burger King needed in order to buy inventory, let's say, like buy burgers and patties and French fries and potatoes or whatever. So that's what that means. Sponsor equity, we need to add later. It's our plug. All this information we can add later. But total here basically is the sum of this. And there's a lot of stuff we need to kind of add in a little bit later. So let's get to uses though. There's equity payment, which is like paying off all of the equity holders. And then there's debt refinancing. transaction fees, financing fees, and then other, which I will explain later. So for this as well, we are going to, or let's figure out what all of this is. So for the equity payment, this is up here, this 3325, right? This is what you need to pay to all the equity holders. And again, something we're trying to back into is this like $4.3 billion number. This should be what this eventually becomes. So equity payment, as I said, is up here. This is what you pay your equity holders. Debt refinancing. So this is the debt that you need to refinance. So what happens in an LBO is that a private equity firm will get all of the company's debt that it previously had and then get new debt, right? Which is everything you see here. And the reason it does that is because the private equity firm typically wants to take on more debt, new debt, and will refinance everything usually with better interest rates because they have connections with the bank and do this all the time. Okay, and then transaction fees. You can see here, fees and expenses related to transactions total $91.2 million, and this is what they paid investment bankers, lawyers, compensation-related expenses, I guess here, commitment fees for bridge loan. So $91.2 million, right? For a $4.3 billion deal, they paid around $91.2 million in transaction fees, which I don't know, it's kind of a lot. Not saying that they paid more than they should have or whatever. I'm just like always astounded by like how much money is moved around in these kinds of things. Okay, so this is linked to the same sheet, so it's purple. This is a hard code, so it's blue, and I'm going to link this to the 2011 10K page 87. We got that here. Financing fees are here. And then we need to get to a total of 4.3 billion or so. Let me remember what I did here. So we want to eventually, the key number that we want to get this to, or this to, is $1.56 billion in equity, right? So I'm going to back into this number a little bit. So 4.24 billion. The sponsor equity is always the plug. This is always how you do it. Your total sources should always equal your total uses, and it shouldn't be a penny less or a penny more. It always needs to equal each other. So this is actually going to equal this. And then your sponsor equity is the plug. So whatever remaining capital that the private equity firm needs in order to fund the transaction is going to come from the private equity firm's fund, right? So the sponsor equity that needs to be paid is the total here minus the sum of the rest of the sources, 1528, right? But it says here 1.56. So that means there's, in order to get to this number, there is like something else that is not talked about. And it's a really small number, but it is like 40-ish million or 32 million or something like that, right? So in order to back into this number, basically what I did here, or what I'm gonna do, is I'm gonna get 15560 minus this, and I'm just gonna say, okay, there was 32 million somewhere else that needed to be accounted for, but is not talked about in the filings or whatever. So I'm just gonna say that this 32 million, there's another like line item we need here. So I'm gonna add a note here to get to 1.56 billion in sponsor equity, adding this extra line item. And you can refer to this in the you can go to the 2011 10K page 87 to refer to how I got this 1.56 billion. So this way, if like an associate ever came up to me and was like, hey, like, why'd you add this 30.32 or whatever? I'd be like, okay, like, look at this note. it says that the sponsor paid 1.56 billion. All right. So we have a lot of the key figures that we need here for sources and uses. Again, we need to get to our EBITDA figure. This will really help us basically fill in a lot of this information that we are missing right now. And that is actually the next step. So what we're going to do next is get our financials. And this is also actually going to take a while because we're going to literally copy paste all the figures. So bear with me here. Okay, so let's go to the 10K. Financial statements. So we have our figures here. Before we do this, since I'm at like a natural stopping point, let's see if there's any questions in the chat. What was the gender ratio male to female at JPM? So I would say actually for analysts and associates, it's pretty even. And during my class in New York, like I was in SF, but in New York, there are actually more girls, like a lot more girls than guys. As you go up the ranks, okay, so let's call it 50-50 for analysts and associates. And then once you get to like VPs and directors and above, usually I guess VPs start to get like 65-35, and then the directors, the lower level directors is more like 60-30, 70, 75-25. And then once you get higher and higher up, it's like 99-1 or something like that. Things may have changed though, and these are all just super random. Watching this while eating a double Whopper, I love it. But how does Burger King use this cash on hand to fund the transaction if it sponsors equity? How does BK fund it then? So BK is not the one funding it. It's just that the private equity firm can just use the cash in order to fund the transaction. All right, so financials. The company fiscal year end is on June 30th for whatever reason. I honestly really hate it when companies have a weird fiscal year end. But can't control that. Okay, so we're going to have an assumptions table here. But not worry about this until later. And then we're going to need the operating model. So let's figure out what we need here. So revenue, percent growth. I'm going to indent this. Okay, and then we're going to need our COGS. This is percent of sales. And gross profit. Also percent of sales. OPEX. Percent of sales. Again, EBIT. And then we're going to build out two cases. And I'm going to show you why this is like actually so important and why I decided to do it. You'll see. But we're going to have a conservative case. And then we're going to have a management case. And then we're going to need interest expense. And then interest income. Earnings before taxes. And then taxes. Percent tax rate. And then we get to our net income. Okay, so a lot of figures here, and we are going to need to get all of them by hand. And I'm doing this because I get a lot of requests for the DCFs at least of like, oh, what if you don't have FactSet? How would you get your figures? And while we're not doing it for a DCF, it should be kind of helpful to do this on your own. Or you can build this out without any software or anything, basically is why I'm doing this. Okay, so as I'm doing something a little boring and basically copy pasting a lot of figures, let me know in the chat where you guys are from, like what country or city. Always curious to know, where you guys are from. Okay, but to look at as you guys are doing that, the numbers here are in the financial statements. This is the 10K. Best practice is always to copy paste. It's very, very tedious, but it will save you from making a ton of errors. So 2502. Okay, COGS. So let's see, total company restaurant expenses. Okay, so the company just basically treats a lot of these basically as their cost of goods sold. So other companies may think, okay, when I pay an employee, these are SG&A expenses. But for a food company, part of the actual like cost of the food and delivering it, I guess they treat as what they pay, or they include what they pay as employees, not just the food and paper and product costs. So actually, I think maybe a faster way to do this, I can copy paste it. This is from 2010 though. This is from 2012. I'm going to change all the formatting later. Gross profit, revenue minus your COGS. OPEX. Other operating income and expenses. Total operating. So this actually adds everything. So we're going to need to back into this. Ooh, I'm using my mouse. Should not do that. Okay, so OPEX, since they annoyingly like combine everything, we're going to need to back into this. I copied it. So what I did here was, oops. What the heck? There was like some way I changed the color, which would save me a lot of time if I knew how to do that. Okay, whatever. So what I did was I copy pasted the total number here, and then I subtract. I can't control Z back into it. Okay, I'll do it again. So this is for 2010. Wait, am I doing this wrong? Oh no, this is right. So 2169. Other, okay, total operating costs and expenses, 2169 is 2010. And then this is 2009, and this is 2008. So in order to get to this figure, what I'm doing is getting the total minus the cost of goods sold, right? These are the right figures. But if I copy paste this here, this is going to just get to, or it's just going to copy the wrong cells or whatever, right? So what I'm doing here is Control Shift right arrow key, Control Copy, and then Alt ES V, and then that pastes the values. Then I can delete all this. EBIT is our gross profit minus our OPEX. And then interest expense, have these figures here. So this is 2010, this is 2009, that's 2008. Then here is the interest income. Whoa. Okay. And it's negative here because they're subtracting it out, and interest income is positive, right? You're receiving money. Since the formatting is a little weird, I'm just gonna actually hard code this one. So 5.9, 2.7, and 1.0. And I personally like to keep every single number in the model positive, even if it's an expense, something you should subtract out. But other people like to make everything negative if you're subtracting and then subtract it out. So that's just totally personal preference. Okay, so all of these are hard codes. So I'm going to get this Alt EST for the formatting. And then you can just press F4, which will basically repeat what you just previously did. Okay, and then EBIT minus interest expense plus interest income gets you to your EBIT. And then taxes, income tax expense here. And later on, when you download this model, like you don't need to do all of this stuff I'm doing. This is very tedious stuff. But I guess good maybe to see like how to do it. Okay, so this was a hard code. And then let's get the percent of, well, first we need growth. So growth is the current year minus previous year minus 1. I like to have the percentages in parentheses, which is not here. Okay, I don't want to build this out, so I'm going to take it from one of my other models. Oh, actually, so I'm going to do something that's a little bit different than the DCF models that I used to build, or I streamed, and build out the assumptions over here. So revenue, we're going to have revenue, growth, gross margin, EBIT margin, tax rate. Oh, and I see a lot of you guys are from all over. Actually, I'm going to have to. Okay, so we're going to have all of the assumptions here. So it's the reason I put it on the top. I think sometimes a lot of like different modeling Excel, I don't know, sheets and stuff that I come across, a lot of them like to have these on the bottom below. But I always like to have assumptions at the top that drive everything, like as much as possible, because then you can like change these things. It's like more easy, it's more quick, you get quicker to like seeing where the assumptions are, like up here and stuff. In an ideal world, all your assumptions are in one section at the very top, but I think like sometimes it's better to have it in elsewhere. And the reason you want to have your assumptions kind of all grouped together, ideally at the top, is because then someone can easily change some things and like kind of see if you have an IRR reference number here, which we're gonna have later. You can easily just change some assumptions and kind of just see what happens to everything. That'll make sense later. Okay, so revenue. So we're gonna have basically all the percentages here. So revenue growth, we're not gonna have for this first one. This minus 1. So since these are historical, these are just calcs. Gross margin. And if you put an anchor to the row for the revenue, then you can use the same formula. Actually, no, you can't, because you need a different line here. So, but anyway. Okay, so that we have our EBIT margin. Actually, do I want to do it this way? Yeah, I will. Okay, and then tax rate is the taxes divided by our earnings before taxes. Hmm. Oh. Oops. Okay. So these are all links, or these are all calculations. So they're gonna keep. I'm gonna keep them black, and then let's calculate all these other ones. So, or let's get all these other ones. Okay. So there we have the one. We have revenue growth. This is gross margin, EBIT margin, and then tax rate. Dollar size. And then there are some that we're going to just calculate here. So this is cost of goods sold divided by our revenue growth. And the reason that we're not doing it for every single one is because these 4 are the ones that we just need to make assumptions for. All these other ones we don't really need to. So this is for our cost of goods sold. And then since I anchored the revenue row, I could just copy paste for all the ones that are percentage of sales. This one and that one. Okay. So we have our historicals now. And then the question is, okay, what kind of projections do we need? And this is where a lot of the time people are, when they're asking about like projections from like, oh, if you don't have good access to FactSet or whatever and projections, like how would you actually get your numbers? So that's what's actually really helpful about the proxy that I mentioned here. Or I guess like earlier on I referenced this if you're like joining more recently, but the really interesting thing I think personally of transactions is that they actually give you a lot of information of what the company was thinking at the time. So if you look here, there's this line that says certain company projections. If you go here, you can go down a bit and you can actually see these are a summary of the 5-year projections that the company actually thought that it would hit, right? So, and normally like getting projections, like management projections for any company is like impossible unless you're like an equity research analyst or a hedge fund analyst or something like that, right? So what's cool here is that we actually have this case of what management told 3G, like, hey, we think that we can hit these numbers, and these are numbers that you can probably plug into your model in order for you to build out your LBO and all of that. So we can use these numbers basically to get to a or to build out our projections essentially. Or actually we can actually just use these numbers. So we're going to use the numbers for revenue. Formatting's all weird, but so in a future video, when I build out like part 3s and like make this more complicated and whatever, we're going to build out revenue cases. But for this video, we are going to just use what management gave us. So I'm going to add a note here that this is from Prem 14A, page 60. Okay, and so for here, we're actually going to back into this as well. So this is, and this is interesting, right? Even management, I guess, like has told the company, like, we're going to decelerate. We're going to probably get rid of a ton of Burger Kings for the first few years and then kind of regrow it as they figure out their operations in a sense. So that's what we're going to do here for our revenue growth. And then cost of goods sold and all of this, we're going to back into, but, and I'll explain why in a bit. But let's also get our management figure here, which is here. Right? So this is the management figure. I'm going to add the comment here as well. And then we can also do this as a percentage of sales. Okay. Okay, let me just remind myself like what I did. Okay, yeah. So the reason that I want to have two cases is that it'll just make the model more dynamic. And then also, you don't want to just believe what management is going to tell you, right? Like the company thinks here that, or management is saying we can get from 13.6% EBIT margins to 29.1% in 5 years. And that's honestly pretty aggressive. And so what I want to do is have like a more conservative case as well, in order to see like, okay, if we don't believe management, maybe we have our own case and see like what our IRR would be. So what we're going to do here is build out our own projections a little bit. So in our first year, what we're going to do, like you can see here, previous year was 13.3% margins, and then they say it's going to be around 13.6. So what they're basically saying is we're not going to see much improvement in year one. We're going to see a lot more in the following years. So to be a little bit more conservative, what I'm just going to do for our gross margin and EBIT margin here is just make it the same as the previous year. And I'm going to indicate that I'm doing something like different, which is what red color coding means. And then for these following years, we're going to build out a separate, or we're going to project these out basically. So I'm going to add something called this section for projections that's very common called step. I actually don't know why it's called step. Well, it's called step probably because it's like you like step up a little bit, but I don't know. They could have called it anything. So I'm gonna say that it's because I've done this in advance. So what I do here is 1.75%, 2.25%, I believe. Or not 2.2%, and then 0.5%. So what I'm going to do is basically just add to our gross margin and EBIT margin here. You'll see why I chose these numbers in a bit. So I'm anchoring here. So basically this is our gross margins are going to improve by 1.75% each year, and then our EBIT margin is going to increase, or sorry, this should be OPEX margin. Our OPEX margin, so this should actually be this. Oops, that's wrong. This should be this. So these are adding these two together will get us to our EBIT margin that we're projecting, right? So, okay, I also did this wrong. Our gross margin should be increasing over time, while our OPEX margin basically should be decreasing over time because it should be improving. So our OPEX margin is decreasing over time to 13.4%, and then our gross margin is improving over time. Okay, so what we want to do in our conservative case, we're going to need a switch here. Oops. And what we're gonna use the circuit breaker thing a little bit later. But what we want to do here is add. If you go to data, so Alt AVV, we're gonna add a list, and then we're gonna call this on or off. So this basically lets us go either on or off. Oops, I think I did this wrong. I don't need parentheses. Let's Alt AVV. Okay, wait. List. Oh. And we're going to use this later, but since we're building out our switches now, we'll just have it. And then for our cases, we also only want a list here, and we only want 1 or 2. And then what I'm going to do here is I'm going to add an if statement. So if this case equals 1, then we're going to have a conservative case. This is just for us to know what is being used. Otherwise, we're going to have it say management. So this will always help us know what case we're on, essentially. So you can see here, switch to 1 or 2. And then I'm going to name this cell I'll name it case. And I'm going to name this one circ. Okay, so let's start building out all of this stuff first. So, okay, let me remember how I did this part. Actually, okay, yeah. All right, so let me start off with like the basic stuff, and then we'll build it. I guess we'll make it a little bit more complicated. Or I'll add all the other stuff a little bit later. So, gross margin. Basically, if we were to not worry about anything else, then basically what we would do is just copy paste this across, right? Oh, I also did this wrong. So up. So this should be up here. EBIT we calculate. Okay, so we copy this. Okay, so then if we weren't worried about anything else, we would basically back into all these figures. Okay, and this is going to be, so that's going to be that. This times revenue. This is going to be OPEX times revenue as well. And then we can back into our COGS figure, right? Gross profit minus our, revenue minus our gross profit. And then you can see here, okay, so it's important to always, like after you build out your projections, look at the trend. So it's around 62.7, 64.5, and this goes down to 57.5% for COGS. And you want that to be decreasing over time. It means you're becoming more efficient. Gross profit, you want to see it increasing over time. So, okay, we're assuming it grows up to 42.5% when it was historically around 35 to 37%. OpEx, you're seeing it decrease to 13.4%, which is really aggressive. And I'm going to explain soon why I decided to make two cases as I was like prepping this model. So if you see here, management assumes that we're getting to this 29.1%, right? So in our conservative case that we built out here, this is our gross profit minus our OpEx. And so this is, copy paste this. So this kind of tracks to our management case, right? So 13.3, a little bit more conservative. Year 2, 17.3. Year 3, 21%, 25.2. And basically the reason that I earlier chose these numbers here is because I wanted to eventually end up to this 29.1%, which I thought was pretty aggressive for an EBIT margin for like this food company. But like in these 4 years before, it's lower than management, right? So we're clearly being more conservative. And when you're modeling, you always want to be more conservative, generally speaking, because usually tons of things go wrong. And so you want to make sure that you're giving yourself cushion. And I thought that I'd be very surprised if Burger King actually was able to reach 29% EBIT margins. And that's because that's really, really high. And so, I mean, if any company could do it, maybe a private equity firm could. But as I was building this out, I thought, okay, these management figures are too optimistic. I want to have a conservative case. And so that's why I built this. So I'm going to use a choose function. So if case equals, choose case, and then either this one or this one. So what you probably saw earlier, I named you can name any cell by clicking on the top left here and then naming it something. So this just makes it so that I don't have to scroll all the way back up here and then like link to this. I can just use that naming instead. So this choose function basically is like, okay, if the case is 1, choose this first one. If it's at 2, then choose this second one. So right now it's at 342. But if I switch this to management case, then it's 351, right? And then percent of sales, we can copy paste here. But there's a little bit of a complication, right? So right now, everything is on the management case, right? Everything's on the management case, but the OpEx and gross profit, COGS, these are still on the conservative case, because if this is being linked here, it's not. So if we were to actually look at the figures here, so gross profit minus our OpEx, that gets us to 342. So this is very, very misleading, and it's not what you want in your model, right? You want, whenever a case is turned on or off, for all of the relevant figures to be updated. And so if you were to output this or something and send it in like a PowerPoint deck, then your MD or ED or VP, when they're looking at it and reviewing, they're going to check to see if the numbers make sense, and they're going to be like, hey, like, why did you output this like financial table and the numbers like don't actually add up to what EBIT is, right? So you want to kind of build something that's like will prevent something like that from happening, right? So revenue we don't need to worry about. But basically what I'm going to do here is, if the case is set at 2, then I'm just going to have this, placeholder thing to really say like, hey, don't like these cells aren't being used. What the heck? Oh. And then we're also going to do the same thing here. So if case equals 2, then don't use this, basically, is what I'm saying. All right, so right now, since the case is at 2, we don't want any of these to be showing. And we're going to do that basically the same thing for all of these. So if case equals 2, then show nothing. Actually, I can copy this. In this one, if case equals 2, show nothing. And I'm Alt ESF formula, copy pasting it across. Same with this one. If the case equals 2, then show nothing. Whoa. Oh. So yeah, a little bit tedious, but not much else you can do. Show nothing. All right, so now this is good in that when the case is at 2, these should show nothing, right? This basically indicates, okay, we are not using these figures here. But there's this issue here where, okay, if a case is at 2, you don't want to see a bunch of value errors in your model, right? You don't want that either. So right now what this is doing is pulling from the second option here because case is set at 2. But when we switch to our conservative case, then you want everything to repopulate, right? And as you just saw, when I switch from case to case, there's like this shows as an error, and you never want that to be showing in a model. So what we are going to do here is add something called sticky ifs. And so these are what are called like sticky if statements. And I remember when I was learning this, I thought it was like, I feel like it's actually not that complicated at all, really. Nothing in Excel is, but it is a little bit more of an advanced kind of like formula or like whatever. And you'll see what it is. So basically what we want to do is ultimately what we're doing is with sticky ifs is we want these numbers to stay here even if we change the case so that there is no value error, right? And so you'll see how this works. So basically it's if case equals 1, right? So if the case is on conservative case, then we want what we have here, right? Simple as that. But if not, then we're adding another if statement in here. So if case equals 2, then what you want is the actual cell here. And then if not, then this same, this same formula. All right. So beforehand, you saw that if I changed the case, it added a value error, right? So if I change the management, now this number actually stays at 342, right? Where even though all these numbers are now gone. And what this is actually doing right now, if you look at it, it's actually taking from 2 blank numbers, but it's keeping it as the numbers we had previously. So this is to kind of go over this. What this is basically saying, like how first you have to understand how if statements work, which is that it's very simple. It's if this scenario is happening, then give me this. If not, then give me this, right? It's a lot simpler when you look at like this one. If case is 2, aka if it's a management case, then give me this blank. If not, then give me the COGS margin in this scenario. When it comes to the nest, I think I actually also call this nested if statement, but then we also always just call it sticky ifs. So if case equals 1, so if it's on conservative case, then just give me G62 minus 65, which is just give me EBIT. Give me gross profit minus OPEX. If not, then when case is 2, when it's at management, give me what this number was originally, which is at this 342 basically. If not, just give me like this number. So it's, there are kind of layers to this in a sense, but essentially what it does is just it keeps this number the same even if you change the case. So hopefully that makes sense. It takes a little bit of time to kind of get used to, but at the end of the day, it's just like a simple formula. And but when I first learned it, I thought it was kind of cool, even though it's kind of just a formula. So that's your EBIT, and then now we need to calculate the other stuff we have here. I also realized it's a little bit OCD, but didn't italicize these margins part. Our interest expense and income, we're building out an LBO, so obviously this comes later, and I'll highlight it for now. This is a huge part of the whole LBO. Earnings before taxes, this is going to be our EBIT minus our interest expense plus our interest income. Percent of sales here. And then taxes, let's assume that the company is able to, so I have like minus 0.5% here, so I'm just going to assume that it's able to find some ways to decrease its taxes a little bit over time, basically. And I did also double check this to see, and I remember reading that Burger King actually was able to decrease its tax rate by quite a lot, even more than this, but I'm just being conservative. So I'm going to add that there. And then we can refer to the taxes, and then we can calculate our net income. So earnings before taxes minus taxes. This is our earnings before taxes times our tax rate. And then now we can copy paste this across. Okay, so you can also see, as like a quick sense check, you want to be seeing like, oh, okay, what did the margins look like over time? So 9% increasing to 19.8% net income. So clearly the company hopefully or hopes to become much more profitable over time. So this rounds out our financials. I mean, there's more that we have to do, but this is a bulk of the financial section. So now we pause here now and see if there are any questions in the chat. Can you build a I'm guessing you're asking 3 statement financial model, and that's going to be actually, as I talked about, some of you guys might have joined later, but this is part 1 of the advanced LBO. Later on, we're going to forecast cash flow statement, balance sheet, and then do all this extra stuff. Probably going to take me 2 videos, so I'm going to split it up into parts 2 and 3, but later on, probably, since if you joined in the middle of all of this, you may want to start from the beginning or like use this. And we're going to build off what we build here in those future models, basically. Work at middle market bank. Do a master's in finance at LSE to get into bulge bracket. Really hard to say, just blanket statement, but I think if your goal is banking and at LSE it's a very good pipeline, then maybe do that. If, on the other hand, you can join a middle market bank and lateral, then you get actual experience and you're able to lateral into bank. So that could be an option. Like honestly, it's really tough to say what's better or worse. If you want to just keep making money, though, you should do you do the lateral thing. Best degree to get into IB, just anything business related. It could be economics, math is fine, even CS is fine. Why do you use a second if in a sticky if formula? Couldn't work just on if condition. So there's no space to not add another if. Like if I were to, so you see these commas here, this basically just adds another if statement into all of this, and you can add this extra scenario. Yeah, if you were, like, I guess what you might be asking is like, okay, if case 1 equals and do this, if not, then take this. Yeah, it turns to 0. Yeah, I don't think this works. Conservative and then management. Oh. Did that work? Oh, you know, actually you're right. Yeah, my bad. So this makes things simpler. So actually, I guess what you can do is just, I basically made it more complicated. You can just refer back to this own cell, and then you don't need to add all that other stuff. So actually, Dibs, thanks for calling that out. It does work if you just refer back to the cell that you're in. So right now we're in case 1. And even if we change to case 2, the number should stay the same, which it does. So versus this, you always want to make things simpler if you can, especially as your models get like super, super big. Having sticky if statements actually slows down your model if you have like tons of tabs and like all of that stuff. So yeah, good catch on that one. All right, I'll answer other questions later because there's actually a ton left to do. And yeah, there's just a ton left to do. Okay, so net income, I'm going to make this. Basically, you always want to make the kind of important parts kind of stand out. So we got to our net income. Another thing I want to show you guys is something called EBITDA reconciliation. Okay. So let's go to Burger King, and then let's go to, it's going to be kind of hard to find. Oh, maybe it was, no, it was. I'm going to the time when basically the way I found this was, okay, we're using this 10K, which was announced on March 23rd. And then so they probably announced a press release at one of these times, which seems to be the second one. Oh, double check your EBIT. You copy pasted incorrectly. Oh. Oh, actually, I guess you can't use that. Yeah, okay. So you do have to do the thing I said. Why is it doing that? I guess, or maybe I need to, oh, maybe I just need to refresh it. So, I mean, it is here now. Okay, so now it works. Yeah, so it is a little bit buggy, right? Like you do run into these kinds of issues. So you just want to, I guess, basically what happened is sticky ifs, what they do is like they'll calculate it once. Beforehand it was at 0 because I changed the formula and then it was basically subtracting 0 minus 0. So it was like stuck on 0. But then once I changed the cases, it recalculated it and then became sticky, if that makes sense. So that's what happened here. Thanks for Zakaria. Thanks for calling that out. Okay, so EBITDA reconciliation. What is this? So every company, okay, this is not what I'm looking for. What the heck? Where's that 10K filing? This is why it's usually great to have all of these showing what all this is saying. March 23rd, 2011. Should be one of these. Okay, we'll go back to 2010. Oh, I think I looked at the 2010 one. Okay, so August 26th. Should be one of these. Ah, here it is. Okay. So every company, EBITDA is what people use all the time, but it's actually a non-GAAP figure. It doesn't show up on a financial statement, or it shouldn't. Maybe it's referred to, but companies always talk about like adjusted EBITDA and whatnot because they make changes to, there are always like little things that happen that the company says, oh, you should be adding this back to EBITDA basically. And and then when you go to a company's press release for their earnings, they always kind of give you what they believe EBITDA should be. So let's find that. Yeah, adjusted EBITDA here. All right, so I thought they had it for 3 years, but I guess not. Either way, I just want to show you what it is, and we're not going to worry about it and / use it too much anyway. So what we're going to do here is get our EBIT, DNA, adjustments. That gets us to our EBITDA. So we're still in 2008 here. So we're going to go to 354. DNA, something we're going to need to grab from the cash flow statement. DNA here, copy these. So 20, okay, yeah, and then adjustments. This is what I'm just basically trying to show you guys. Usually it's a lot more, there's a lot more, but for Burger King, for whatever reason, they only have like these 2 adjustments. A lot of other companies will have like stock-based comp and then like all these acquisition stuff, and it'll be like a lot of numbers and it'll make your EBITDA a lot bigger, which is when it's kind of useful. But in this scenario, it's like they're just adding 1.5 and 2. So in 2009, they're saying add 1.5 plus 2 back. For our other figures here, we're just going to have 0. And I'm going to add a note here. This is in filing here. And then this gets us to our EBITDA, right? So you add these back. So normally, if you were just looking at GAAP, or sorry, it's not GAAP EBITDA because there is no such thing. But if you're just looking at normal EBITDA, then it'd be 4 less, right? And then, as I said, usually these adjustments are a lot more, and you want to account for them as you are building out your EBITDA for your projections, right? And that's why it's really important. But for this specific LBO, it's not important. Let's also add here percentage of sales, which we can add here. And the great thing about doing this now is now we have our EBITDA, our last 12 months EBITDA. So we can go back up here. If you forgot, we do still have a lot more to a little bit more to add and change here. So LTM EBITDA, this is not our pure LTM EBITDA, right? This is 2010 as of June 30th, 2010. And so ideally, you actually want the last 12 months, like literally the last 12 months of financials, which a private equity firm may have something closer to. But in our scenario, we only have the public information that's available, right? So the closest we can get to is the latest filing that is provided. So we are going to treat this as our last 12 months EBITDA. And a real private equity firm would actually just once you're actually in a transaction, the company will give you all the numbers you need. It's in their best interest to do so. So LTM EBITDA is here as well. So now we can calculate what the entry multiple was, which is our enterprise value divided by our LTM EBITDA. And I'm going to format this. Yeah, I like, you see here like this extra little spacing. I like having everything just the same. Okay, so 8.8x, it's pretty interesting to see. Okay, this is what the company entered the transaction at, that multiple. And then we can assume that the company is going to just enter at the same multiple. Obviously that's something you might want to change later, but normally a good conservative assumption is that you're going to exit at the same multiple. And the reason for that is because you don't want to assume multiples always change depending on the market, and so you don't want to make a assumption that it's going to get higher, right? Like you can't, that's out of your control. Okay, so now we have all this information filled out here. We can also finish out our sources and uses table too. All right, so percent of EBITDA, this is this divided by our LTM EBITDA. Just a bunch of helpful information to know. And then percent capital, we didn't fill this out either, which is the amount and then divided by the whatever you're looking at. Okay, we want the same thing here. And then percent capital, we want to move this there. Yes, this will be posted. All the streams are always posted. Okay. So you always want your percent capital to equal 100% because that's 100% of your capital. And then you can see the EBITDA figures here. It's interesting for the debt. You can see what how many turns of EBITDA basically that the transaction was funded with. And I was always instructed at JPM that you never want to go above 6. I don't know if that depends too much. It might be different now / also dependent on the industry, but interestingly here, they're right at around 6x EBITDA. Although the EBITDA figure that they use might be a little bit different. But we're in the right ballpark is basically what it seems like to me. All right. So now that we have everything up there figured out, what we have left to do is figure out what our cash flow items are, and then also we have to figure out we have to calculate our EBITDA projections and stuff, but then we have to figure out our cash flow items. Then we can build out our debt schedule, and then that's pretty much the whole thing. But it looks like maybe another hour or so that we have left here. So EBITDA conservative. So, and this is percent of sales. EBITDA management, percent of sales. All right, so this again is going to be dependent on the case that's being used. Okay, so for historicals, we don't really have to worry about it. It's just going to be, what's up here. All right. This also needs to be purple. Purple, by the way, is when you're referring to a cell in the same sheet. Okay, and then so for conservative, let's see what I did here. All right, so as we went through earlier on, there is EBITDA that's provided by the company. So I wanted to basically, when we're on our management case, we want to show these figures or use these figures. Whereas if it's the conservative case, we're not using these figures. So this is management. And these are hard codes. This is in the pre-M14A page 60. Okay, and then percent of sales, we can again copy. These are our EBITDA margins, right? Conservative case, what I think we're going to need to do is actually build out our cash flow items first before actually being able to calculate what this would be, because we need our DNA, right? So what we're going to do is build out a new section now called cash flow items. And what we're going to need are three things, which is our net working capital, and then our DNA and our CapEx, right? And we're going to do each of these a little bit differently. I know we are kind of like right now doing EBITDA, but I'm going to start with our net working capital and then do our DNA and CapEx. So if we go to, we're going to need these historicals again. So if we go to our 10K, the company gives us our everything we need, right? So these are the current operating assets and then the current operating liabilities. So we can actually just copy paste these. I don't know how it's going to look actually if I copy paste everything at once. Might get messy. Okay, it's not too bad. Okay. So this was, the numbers are, these are for 2010. These are for 2009. And these are for 2008. And we don't want any of this stuff. All right. I see some of you guys are still here. Let me know if any of you guys have been here since the very beginning. I'm curious to know. All right. Because this is even taking me longer than I thought it would take me. And I can assume that this is kind of dry for the average person. But if you're interested in finance, maybe it's not that dry, right? Okay, so these are trade and these are like accounts receivable. These are prepaid and current assets. So these are our current operating assets. And these are our current operating liabilities. And we need these to calculate our net working capital. So these figures here, they're also, for me, I find this stuff a little bit confusing. So I actually have these notes that I wanted to, that I'm also going to add in this model. When you download it, you're going to be able to see on the side here. So, and this could easily be like an interview question. But negatives on the cash flow statement for assets mean that it's an outflow of cash. You've been spending money. And that's why in here, when you see negative 15.9, it means you're spending cash, right? Positive for assets means it's an inflow of cash, meaning that you have gained money. And then a negative on cash flow statement for liabilities means an inflow of cash, meaning like if you increase your accounts payable, that means you got cash and need to pay it, right? Or negative. Sorry, yeah, negative means that. And a positive on cash flow for liabilities means an outflow of cash. So what does this mean here? So we have all the numbers as positives here because I copy pasted it, but this means that for the numbers here, 9, this negative outflow, I'm gonna, because we're gonna be doing our, actually let me just like, do this part first. So the way we're going to be calculating this is equals the sum of your current assets minus the sum of your current operating liabilities. And then again, percentage of sales. This is what we're going to use to forecast. Okay, so in terms of the signs, when it's an outflow, let's refer to this. Negative, actually basically what you need to do is kind of, let's think here. What we need to do eventually is flip the signs for the assets, because basically this implies like an increase of current assets, right? Because cash has gone out, you're spending more on current assets. So that's why the negatives need to actually be positives in terms of the way but this needs to be negative in terms of the way I'm calculating things. Oh, God. These are all for 14.9. This needs to be negative. And then for liabilities, 20.8. This positive, positive. Accounts payable. This is negative. And then for accrued advertising, this is negative. Other accrued liabilities, these are all negative. So this gets us to negative 1.3%, 2.3, and 2.2%. And I'm just going to make a simplifying assumption and average these. So in the future model that we build for Burger King, when things get more complicated and stuff, I'm going to be actually projecting out all these like cash flow items. But for this one, we're actually going to be just using the simplifying assumption. Oops. Okay, so multiply this by sales. And now we have our first cash flow item that we need. And we just need 2 more. All right. So that's done. Okay. Now we need DNA. Percentage of sales. DNA is conservative. DNA management. All right. So the reason that we need this is because we can back into our DNA here, right? And we'll do that here. So management is our EBITDA minus our management EBIT. Conservative case, this is for this, we want to actually just project what our DNA would be. And so I'm gonna copy paste this. So we already got it earlier, so we don't need to do it again, but I'm actually going to link down to this. It's just like preference. Okay, so then we can get percent of sales here. So for our conservative case, what we want to do, actually we can just make this part of historicals. We don't really need that here. What we're going to do for our conservative case is just use a 3-year average, very simple. And then hold it steady over time, since it's not really changing that much anyway. All right, and then, so this is this times our sales figure. All right, so that's our DNA here. And then what we want to do with our DNA is basically just use a choose function. So if case equals 1, choose case, and then either this one or this one, depending on what is needed or what you choose. Okay, so then this. Okay, so we got our DNA. Now that we have our DNA, and the reason I have conservative and management is that for, if you've been following along, I guess, management, we are given EBITDA, we are given EBIT in the proxy, right? Given, and so we have like a management case of what EBITDA and EBIT should be. In our conservative case, we're calculating this on our own, right? We made our own projections, and this is a conservative case we want to compare against to see what our IRRs are when we have our more conservative case. And we have to calculate our own EBITDA. So that's why we have both. And we can get our DNA now here for the conservative case. Make this purple. And then this as a percentage of sales. Oops, this needs to get our DNA plus our EBIT. All right, so that's our conservative case EBITDA. Yep, looks good to me. And then here again equals choose case, this one or this one. All right, so we have our EBITDA projections, super important. Formatting looks a little different here. All right. So we have our EBITDA. Okay, so now I realize I've been looking at this computer screen for like 2.5 hours straight. So I should probably take water break. All right. Sorry, these the formatting looks a little off. Okay, so we have our DNA. CapEx is going to be really easy. We're just going to pull from our 10K, which is our payments for property and equipment. All right. These are negative numbers, but for me, I like to keep everything positive, as I mentioned. And then we're just going to use historicals to project this one out. So this is the percentage of sales. We're going to be doing an average. Multiply this times our sales. All right, as I'm doing all this like kind of basic stuff, quick little plug. I announced my streams on my Instagram, so feel free to check that out. And I've been posting a lot of Instagram Reels and TikToks, which you can also check out. All right, so we have our cash flow items. Now what we can do is calculate our levered free cash flow and then get to our debt schedule. Yeah, so now I think we have about like 30 minutes left before we can finally get to our IRR. So let's call this levered free cash flow, and then net income plus your DNA minus your CapEx minus your change in net working capital. And then mandatory debt repayments. Like this is something that we are going to add to our next model, but for this one, we're not going to. So net income, you can scroll all the way up here. Then plus, oops, we don't need to do that. So net income is there, DNA here, CapEx here, change in net working capital here, mandatory debt repayments, I'm going to put as 0 for now. So this is a hard code. These are referencing a cell that we have. And that's pretty simple, right? That's all we needed to do to calculate our levered free cash flow. All that work leading to this. Plus DNA, minus CapEx, minus change in net working capital, minus any mandatory debt repayments, which we are not going to do in this model. So that's it for levered free cash flow. Pretty simple. And then we're going to need to build out our debt schedule. All right, I'm going to add X's here also, so that's easier to navigate. Okay, this is debt schedule. We're going to calculate our debt pay down first, and then we're going to calculate our interest. All right, so something that's a little bit different than the other LBO stream that I did earlier a month ago or so was we didn't really calculate our cash at all. So that's something we're going to do in this model. So we're going to need beginning balance, and then inflow versus outflow, and then ending balance. Oops. We're also going to want to get our 3 tranches of debt. So we have the USD tranche, Euro tranche, and senior notes. Next model we build for this LBO, we're going to also have a revolver, but we're not going to do it for this one. Beginning balance, pay down, ending balance. That's all we need here for these. Okay. So let's build each of these out. So that we're not going to have to worry about 2008 to 2009. And for 2010, all we need are the beginning balances. So for this cash, that is the minimum cash. So once the transaction is done, this minimum cash, let's just say, is what we need. Like it's true that this cash balance that you're using, like, you may not be able to get any interest. The reason we're calculating this is to calculate our interest income, because when a company has cash, they don't just have it in the bank. They usually try to receive some income with it. And so they'll get like 0.5% of interest income. So that's why we have this figure here. And the minimum cash balance, you could argue like, oh, you're probably using it and you don't have all of that money. But for simplification purposes, we're just going to assume that that is the ending balance for the year. Okay, so now we have our ending balance, our beginning balance of our first year of projections. We can do this for our 3 here. And then your interest in your cash, this is going to, if we were to have built out the 3 statements, then we could kind of add like the inflow outflow here and everything. But since we don't have that for this model, I'm just gonna make this 0. All the cash is gonna be used to pay down debt anyway for this model. And so the ending balance is just gonna be the beginning balance plus any inflows / outflows. So we can just copy paste this across. And this is going to be pretty simple. We'll use this later. Now this is where we start paying down our debt, right? And so our levered free cash flow, this is what we're using to pay down any debt. And this is often called a debt waterfall, because when you have the cash that you have generated, you first pay off as much as you can of your first tranche, and then what's left over, your second, and then what's left over with your cash, your third. Now in our scenario, like we don't have like that much cash, so all of this is going to be really honestly paid to just this first tranche of debt. But you still want to build the model as to be like pretty dynamic, so that it's still using, it can, if you have like a lot of cash or something, it's using for all of these different tranches. And later on, we're going to build out something called a cash sweep. And basically what this model is going to be able to do later on is choose like, okay, I want to pay like 50% of this debt tranche and then 50% of this one with my cash and etc. But in this scenario, we're just going to start paying off this first one. So what we want to do here is basically choose, let's see, the minimum of either our levered free cash flow or our beginning balance. So that's 135, right? So the ending balance here is our beginning balance minus our pay down. Right, so that's how much cash we have left. And then the formula pretty much is the same throughout. Right, so you can see here, 205 million in cash is used to pay down, then 257, then 294, then 333. We end up with 287 left. And then we want to do something similar for our next tranches, right? So equals min of either your levered free cash flow or either the minimum of beginning balance or I think it's your man, this always trips me up a little bit. G138. Oh, right. So either this or the cash you have minus your pay down. Yeah, and this should be 0 because basically what this is saying is you want to pay down your debt either with your cash that you have, or sorry, you either want the minimum of what's in your debt tranche or the amount of cash you have left after you pay down your first tranche of debt, right? So that's 0 in this case because this minus you pay down everything, so that's 0. So that's smaller than this 334. So your ending balance is your beginning balance minus your ending balance, your beginning balance minus your pay down. I'm starting to get tired. Okay, but we're almost done. And then senior notes, similar thing is either the min of this beginning balance or your levered free cash flow minus your pay down. Cool. So basically, this shows that you're not paying down debt for anything else besides this first tranche for the entire 5 years. And yeah, that's just how it is here. And then now we can calculate our total debt. Beginning balance. These are just simply, you just need to add these three together for everything. Beginning balance, pay down, and then, so this is our total debt. Okay. And then I guess we can add a check here. So so this, we added everything, but we can also check to see if this minus this equals this. And this should always say true. And for whatever reason, we always like to have our check be red. All right, now almost there, guys. Calculate our interest. This is where things get a little bit interesting, in my opinion. So for interest, there are a few things we need to do here. I'm just going to write all of this stuff out first. Okay, so we have interest income rate, then interest rate. Okay. So what's interesting here is we have this thing called circuit breaker. If you remember way earlier, I named this circ. And I'll explain what this does as I build out everything. And we're going to need to include it in the formula. So interest income rate, we can back into this actually by getting our, we need to calculate this actually, I believe. Let me see what I did. Right. So our interest income, actually, how do I calculate this? Okay. So this is a bit of a simplifying assumption. So actually we're going to call this interest income. Wait, interest on cash, I guess is what we're going to call it. So if we go all the way up to our model here, remember we had interest income. So we're going to connect to that. So this might be a little bit confusing, but this is cash, but we're doing interest income of cash. So there's that. And then if we get this and divide, what did I divide by? Okay, in this case, I guess we just take it from our ending balance in 2010. This is a little seems wrong. Oh, okay. I see what I did wrong. So actually something I need to fix here. Our ending cash balance here is actually what we ended up with, the cash we ended with, right? This is something that we calculated earlier. Once the transaction happens, this is actually not the ending balance we need. We need to change this to our minimum cash. So that's something a little bit different. Now this makes sense to me. Yeah, 0.5% is what we needed. So usually interest income rate is around 0.5% of your cash. And then so make this purple. And then what we're gonna introduce circularity in our model, which basically, if you know anything about LBOs, is something should be very familiar. But your interest expense and income up here affects your net income, which affects your levered free cash flow, right? Because your net income's here, which affects your debt pay down, which affects your interest rate, right? Because the amount of debt you pay affects how much interest you have, right? So normally speaking, like what you would do here is you get your average of your beginning balance and ending balance, just because the actual interest that you earn or pay differs month by month or whatever your term, like whatever it is. But as a simplifying assumption, what you do when you're modeling is just take an average of the beginning and ending balance, and then you multiply that by your rate, and that becomes the interest income or expense, right? But because of this circularity, I'll show you how that unfolds later, we want to add something called a circuit breaker. So that that switch I have up there, so if it equals off, then let's see, then you want it to just equal this G171 times the average. So if it's off, you want to get basically just multiply whatever. If not, then you want it to be 0. And you'll see why later. Right now, so let's turn this on and off. So it's off. So this should calculate to about 1. And don't worry too much right now about what it is. I'll explain it in like 5-10 minutes. Let's just calculate everything else so far. So let's get the interest rate for the other 3 tranches of debt. All right, so we have our 3 tranches. Gonna make these anchored, and then we're gonna do the same thing. So equals if circ equals off, then interest rate times the average of your beginning balance of this first tranche of debt and your ending balance. Otherwise, 0. So this is your interest expense. Let's see if I, how's the fastest way I can do this? Actually, I don't think there's a fast way. So again, if circ equals off, then your interest rate times the average of your beginning and ending balance. Otherwise, give me 0. Last but not least, okay, if circ equals off, give me interest rate times average of beginning and ending balance. Otherwise, 0. Okay, so then we have our total, we can calculate our total interest expense. And then we can get our blended interest rate as well. So the total interest expense, you just add these. It's actually a ton of interest. Blended interest rate is your total interest expense divided by your ending balance, I guess. It's a little different. Maybe you should do it an average of your beginning and ending, actually. Same thing, though, pretty much. So that is our interest. And this is pretty much like the most important part in a sense. So what we now can do is go back all the way up to our income statement here, our operating model, and now add in our interest expense here, and then also our interest income. Right, and then that's pretty much our LBO. Let's reformat this though. Okay, so let me explain the whole circuit breaker thing, but let me also just check what our leverage free cash flow is. Yeah, so it's actually negative in the first year and then goes up over time. Oh, this actually also, this is not good. Your paydown should never be a negative figure. I need to change this formula. So our cash flow is negative, so basically we should be paying 0. I didn't expect cash flow to be negative and have this issue. So I guess I'll just, so if cash flow is less than 0, I'll just have it be 0. Otherwise, do the min function. And I'll need to add this for all of them. I don't think this is the, ooh. All right, so this isn't a reason why you have the circuit breaker thing. So this is actually a good example. A lot of times, because of the circularity in the model, if you don't have the circuit breaker thing, then you will get this error and then you'll be like, oh shit, like what do I do? Right? But since we have this circuit breaker, what it does is it breaks the circularity and then it turns it back on. So now you can see all the numbers are working, right? I'll explain that a little bit further after I fix this last thing. But equals if this is less than 0, then use that min function. Oops. Make 0. Otherwise, use this. Oops. Okay. So now we built out everything. Let me just explain that circuit breaker thing one more time. So you have all these like interest line items and there's circularity in your model, right? I'll just write it down because I know this is really confusing when you're first starting, but your interest expense, your interest in general, including your interest expense, income, this affects your net income, which affects your levered free cash flow, which affects your ability, the amount of debt you pay down, which affects your interest rate or interest expense or income. All right, so interest affects your net income, affects your levered free cash flow, affects your debt pay down, and if you have less debt, then you pay less interest, right? So that affects your interest, which affects your net income, which affects blah, blah, blah. So it's like a circular reference like that. And then, so one thing in your model that I should save, I haven't saved. So one thing that you should need to turn on in your model, if you go to, for me, Alt-F-T, then if you go down, enable iterative calculation, this allows for you to have this circularity. What basically, I don't really know how Excel does this kind of, but basically what it will do is like when you have that circularity, it'll calculate everything literally 100 times until it gets like to an asymptotic type of number where it's like very, very close to that number or something. I think that's kind of how it works. So later, right, like if you don't have this circuit breaker, let's say I break the model, right, and then I'm like doing stuff, like then if I try to like, oh no, like I messed this up, I need to change it, it still gives me this error, right? But if I turn this on, I turned on the circularity thing, right? It's like everything's fixed, and then just turn it back off. So that's what that is. But now let's get to our IRR calculation. And then we're done. All right, so LTM EBITDA at exit multiple, enterprise value, net debt, sponsor equity value, sponsor equity at entry, and then MOIC, which is money over invested capital, and IRR. So this is just all references, right? So LTM EBITDA at exit. We can go all the way to the top and then get to our EBITDA. Exit multiple also at the top, right? This is our assumption here. Why is it so high? Okay, I did something wrong here. Oh, is this right? Oh. Okay, never mind. This is right. They just, I guess, entered at an 11 point. I guess I just thought it was lower, but this should be right. 11.7 times is their entry multiple, so that's also their exit multiple. Enterprise value is your LTM EBITDA at exit times your exit multiple. Net debt is your total debt ending balance minus your cash. And I guess with the minimum cash balance, you can argue maybe you don't take the cash out, but whatever. Enterprise value minus your, well, let's see. Normally, if you project out your cash flow statement and your balance sheet, then you will have a cash balance to subtract from. Like for us, we'll just make a simplifying assumption. Just take out that minimum cash. That gets us to our sponsor equity value. And then, so our sponsor equity value at entry is down here in our sources and uses at 1.56 billion. So money over invested capital. This seems, hold up, wait, I might have done something wrong. Yeah, one sec. Oh. Yeah, I knew this is going to our, oh, something's wrong with this model. This should be 400 something. Okay, I know what I did wrong. So I did not add something correctly here. So this DNA should flow to the historical DNA. Yeah, 445. So then this should be 445 and 8.8x. Okay, that makes more sense. Because, yeah, MOIC is about 2.6x. So that is the money over invested capital. So that's pretty much like, okay, so this is how much the PE firm made. They made 2.6x their money. And then the IRR, you get this to the power of 1 divided by 5 minus 1. And that gets us to a 20.21% IRR. Oops. So, I mean, this is what you're really building towards, right? As a private equity firm, like associate or whatever, as you're building out these models, like it's really for you to eventually get to your IRR. So always a great feeling to get to that final figure, and also to see it as something that is kind of believable and makes sense, right? Because the whole point of this whole model, like from start to finish, was to look at a real LBO and try to see, okay, what did the sponsor think they could achieve and what were their assumptions and all of that to get to this IRR, right? And if this IRR was like 40-something% or like 5%, then you know that some of the things you were assuming were wrong. But if it's around like 15 to 25%, then it's like, oh, okay, you built this pretty well. So the only last thing I want to do here, I like to have like this reference here. So I like to have this because then as you change your different assumptions, which is not too much in our scenario, but you can see, okay, if we change it to our conservative case, okay, IRR is 19%. If we make it to our management case, then it's 21%. What if I change the share value to $26, right? Like if I pay more for the company as a private equity firm, then they do all of this analysis before they actually give the offer, right? And the company ended up paying $24 per share, but when they're building this model, they'll probably like, okay, what if I pay $30 a share? Oh, my IRR is 17.4%. Okay, what if I pay $26 per share? 24, right? So that's just helpful to have this reference on the top right. And then you can also like assume, okay, what if I change my exit multiple, right? Normally you don't want to do that because you want to stay conservative. But yeah, that's why I like to have that up there. And that, wraps up this model. And just to give you a reminder, this was part 1 of this model that I'm going to keep building out. Videos coming later include all this stuff. And you're going to also be able to download this model for free once the link's ready. I will add it to this video's description and in the pinned comment. And there's other stuff you can check out. My upcoming investment banking course, my Discord channel, which I'll add a link to soon, other videos, blah, blah, blah. Check me out on Instagram and TikTok if you'd like. And let me, before I leave, see if you guys have any questions. How do you know which parts of the annual report to focus on for forecasting items? It depends on what you're doing, but if you are just doing like a DCF or something or an LBO, you just focus on the basic stuff. Like, what we went through here is a lot of what you really need for an LBO. But if you're going to forecast your 3 financial statements, then you're going to need to focus on like every line item kind of, almost. One question, would you say a business degree is a good choice or CS? Yeah, I think that really depends on what you're interested in, but CS, I think, would be like a great choice because it gives you the flexibility to pursue other things in the future. And you can still get into banking if you want. You just have to like be able to get good grades because I know CS majors are pretty tough, or the classes can be. But with that said, we're going to build upon what we worked on today in future videos. And yeah, things are going to get much more complicated. And I know a lot of you guys have been asking about, like, can you build out like other tutorials and other stuff? And once we finish all of this, the model is going to be super robust. And if you know how to do everything that I went through today, and then also these future videos, you're going to be, if you are like, interested in finance, you'll be very well prepared. And I wish I learned all this stuff before I started banking, but I didn't have, this channel, I guess. I don't know. Anyway, thanks guys for watching, and hope to catch you guys in the next stream.